The car industry is facing a rather bleak outlook after disappointing half-yearly results for major car makers Stellantis and Nissan. Stellantis, the maker of brands like Jeep, Fiat and Peugeot, reported net income that had almost halved in the 6 months to June. Nissan also slashed its full-year profit target as shares fell by the most since February. Well, Daniel Harrison is an automotive expert at Ultima Media.
Essentially, they're suffering from very similar problems, particularly in the US automotive market. So there's intense price competition. We've known since the COVID period. There's been a price war, largely triggered by Tesla, but also the potential threat of Chinese EVs coming in, undermining them. In the case of Stellantis, they're also suffering from being mid-product cycles. So a lot of their models are becoming out of date. I believe they're going to launch 20 new models later this year to try and revive their fortunes. And the transition to EV has not really materialized at the rate that all of the auto OEMs have been expecting. So they've been caught out by that. And they've also struggled to manage inventory levels. So in that sense, they're kind of taking their eye off the ball. So they're struggling on a number of fronts. And it's very similar in the case of Nissan. Even Tesla's struggling right now with sales volumes and profitability.
OK, well, look, that's a snapshot of the past. Let's talk about the future, because Stellantis and Nissan have both blamed increasingly cutthroat competition and slowing EV sales for their financial woes. How do you see the future, then? How do you see this competitive landscape evolving in the next few years?
It's going to be very tough is the answer. I think Carlos Tavares, the CEO of Stellantis, even admitted it's going to be Darwinian in the sense that there's going to be a lot of losers in this transitional period from internal combustion engines to electric vehicles. There's going to be a lot of business failures. We saw Fisker fail recently. A lot of the Chinese OEMs or electric vehicle companies trying to break into Europe and North America, a lot of those are inevitably going to fail. So what we're going to see is a lot of industry consolidation to get those economies of scale, and there's no point in developing common EV platforms independently. It makes sense to have partnerships, and you're seeing that already with Volkswagen and Stellantis. It has a joint venture with Leapmotor to try and bring down the costs of transitioning to these new electric vehicles.
I want to talk to you about surely one of the world's most famous brands, Ford Motor Company. Before I walked in here, the news that Ford loses $50,000 on every EV it makes. Ford has reported a $1.1 billion loss despite a 61% increase in EV sales. I mean, how does the company improve its cost structure to make EVs more profitable?
Yes, I mean, across boardrooms, that is the million-dollar question. How do you do that? Ultimately, it's about economies of scale. Investing in battery gigafactories is enormously capital-intensive. It requires huge upfront capital, and you can only do that at a very large scale. The problem is the scale is not there in the demand side yet, and it is not as expected to be. Different battery chemistries, you'll see a lot of the car companies are transitioning to LFP or iron-based batteries rather than what's called the NMC chemistry. That's one way they're looking to reduce costs. Perhaps not fitting batteries quite as big to alleviate range anxiety is another strategy. But ultimately, it's about bringing down the cost of the components, because about 30 to 40% of an electric car is the battery cost. So they have to find a way to bring down the cost of manufacturing those ultimately.